Hey guys, in this video, we're going to talk about why you don't need a financial advisor. Now, I know a lot of people think that if they just turn over the control of their finances to a financial advisor, they will do better than if they just learn how to manage their own finances. So guys, let me know down in the comments below, are you thinking about getting a financial advisor? Or maybe you have a financial advisor and you're not sure whether you should stick with that financial advisor or do it yourself. So guys, in this video, we're going to talk about why you may not need a financial advisor, and then make sure you watch till the end, guys, because I'm going to share with you guys a side-by-side comparison of a account that is managed with a financial advisor and then an account that I'm managing myself with a Roth IRA, and I'm going to share with you who's beating who. So if this is your first time to this channel, guys, my name is Susan Velez, and on this channel, we talk about making money, saving money, investing money, and just getting smarter with our finances so that we can catch up for retirement, especially if you are late to saving for retirement. So, guys, I know there's a lot of information out there on whether or not you need a financial advisor. You can read all that information if you want. There's tons of information, and I know some people like me, if you're older than the average person investing and you're trying to catch up for retirement, a lot of people think that if they just invest with a financial advisor, they're going to be able to do a lot better than if they do it themselves. But that's not always the case, guys. In this video, we're going to talk about why you may not need a financial advisor. And then I'm going to take you guys to the computer and give you guys some scenarios on how your portfolio would look if you pay 1% to a financial advisor. And a lot of people, when they start with a financial advisor, they think 1% is not a lot. But I'm going to debunk this myth with you guys and show you guys that paying 1% or even more to a financial advisor is going to hurt you in the long run. So first of all, let's take a look at what a financial advisor is. So a financial advisor is somebody that advises you. They may contact you once a quarter, once a year. I know my partner's financial advisor talks to her once a year. He calls her at the beginning of the year, maybe around January at the beginning of the year, and then he talks to her and advises her on types of investments that he wants to put her money into. So based on this information, guys, all they're doing is they're advising you on where to put your money. And if you have a very robust portfolio where you have estate planning, inheritance, or a very confusing portfolio, an advisor might be better for you. But if you're just getting started, you don't have a lot of money, and you're trying to catch up for retirement, and all you're doing is you're wanting to have a good nest egg when you reach your golden years, then you may not need a financial advisor, guys. So this video isn't meant to sway you one way or the other. I'm really just trying to show you that why you may not need a financial advisor and why you might want to just learn how to manage your own finances as well. So the main reason you may not want to hire a financial advisor is because according to statistics, guys, 92% of the time, financial advisors cannot be an index fund like the S&P 500 or a total stock market index fund. So a financial advisor, if you've ever seen the portfolio of a financial advisor's managed account, you'll notice that they put you in tons of different investments. I know my partner's account, when I looked at it last time, she has several investments that he's put her in. So if they can't beat the stock market, guys, so where do they put your money? So what they do is these financial advisors work for big firms like Merrill Lynch, Bank of America, and several other places that you can find financial advisors. What they do is they offer services that their company has, trying to get people into these services because these services, that's how they make their money. They charge a fee for these services. Not sure what the fees are for the investments. You'd have to make sure that you ask before you invest with a financial advisor. And then on top of the fees for the investments, they also charge a fee based on their services, depending on whether it's a fee-based financial advisor or a fiduciary financial advisor. And that's something that you'll want to check with before you hire a financial advisor, because there's a big difference. A fee-based financial advisor can charge up to 1 to 2% of your investments, your total portfolio investments. And guys, that doesn't sound like a lot, but remember, we're going to go to the computer and I'm going to share with you guys what that looks like. So if you are going to hire a financial advisor, make sure they are a fiduciary advisor, because they are not going to take out fees and they're going to invest based on your behalf. But guys, I still don't think that a financial advisor, whether it is a fiduciary or a fee-based financial advisor, is going to have your best interests in mind, because it's not their money. So make sure you understand this and know that Like I said, most of the time they're not going to be a S&P 500 index fund or a total stock market index fund. So make sure you do your due diligence before you hire one. And then the next thing, guys, the next reason you may not need a financial advisor or may not want a financial advisor is because even if you lose money, if their investments underperform, you are still held liable for paying the fees for the investments that they have you in, as well as the fees that their services require. So you're not off the hooks. It would be different if they underperformed the S&P 500, and then if they did underperform the S&P 500, then you didn't have to pay them their fees, but they are going to charge you the fees regardless of how they perform. So those are the two main reasons that I don't think that you need a financial advisor. But like I said, guys, a lot of people think that when they hear the 1% and they don't understand how to manage their own finances, they think it's just easier and cheaper to hire a financial advisor and wipe their hands clean of having to learn how to manage their finances. So let's go to the computer, guys, and we're going to take a look at what 1% in fees looks like if you're paying a financial advisor. So the first site that I want to take you guys to that shows you guys the cost of using a financial advisor is the White Coat Investor. Now this site is geared towards people who are younger, but we can still kind of, even if we are older, we can still kind of look at the type of damage that 1% advisory fee is and how it would damage our portfolio. And then I'm going to take you guys to another site after this, and we're going to go ahead and plug in some numbers based on the amount of money that I have in my investment and kind of show you what the cost would be if I hired a financial advisor. So right here, it says the cost of using a financial advisor. It says a 1% advisory fee isn't much, is it? So the reason that he says that is because a lot of people, when they hear that it just costs 1% of a fee to hire a financial advisor, they don't think that's a lot of money. But let's go ahead and take a look at the truth and the reality of it. So it says, for our first example, let's consider a quality advisor who charges just 1% of the portfolio a year. Let's compare him to a do-it-yourself investor who holds the same portfolio and achieves the same after-tax return of, say, 5%. Real after inflation. Now these will vary because I know inflation is a lot higher, but we're just looking at the fees, guys, the amount of damage that it would do to your portfolio if you hired a financial advisor. So let's just say that both invest $50,000 a year for 30 years. And then it says, how much more will the do-it-yourselfer have after 30 years? Now, remember, I know that this is geared towards a lot of younger people. Most of us may not have 30 years to invest, but if you're 50 years old like me, guys, you still have a good 20 years to invest if you wanted to invest for 20 years. So it says right here, guys, it says the advised client is in the blue and the do-it-yourselfer is in the orange. So it says we see at the time of retirement, the do-it-yourselfer has $3,488,039. The doctor using the advisor has only $2,916,417. Using an advisor, he cost the doctor almost $572,000, or about 16% of his retirement stash. Divide that out by 30 years, and we're talking about $19,000 a year for advisory services. So guys, that's a lot of money in advisory services. Now, I know a lot of people like me can't invest $50,000 a year for 30 years, and that's why in a bit I'm going to kind of go to And that's why in a bit, guys, I'm going to go to this financial advisor cost calculator. And we're going to plug in some normal numbers, especially if you're investing on a low income like me. And you're going to kind of see the reality of it. So let's come over here, and it says fee-based advisory plus commissions. Now, let's say the advisor is fee-based, meaning he takes 1% and sells you loaded mutual funds, which when I look at my partner's investment account with her Edward Jones account, a lot of these are loaded mutual fund investments, and I know nothing about those, so I don't know anything. I can't tell you anything. All I know is that he's got her in several mutual funds, and I'm not even sure what the price is for those mutual funds. So let's say that 5.75% of every dollar the doctor invests goes to the advisor right off the bat. Loaded funds tend to also be high expense funds. So let's assume that they perform about 1% worse a year than the funds the do-it-yourselfer chooses. Now, what is the difference after 30 years with the fee-based advisor and loaded funds? So remember, guys, The fee-based advisor is in the blue, and then the do-it-yourselfer is the orange. Now we see that the financial advisor has cost the doctor $1.2 million, $40,000 a year, or about 34% of her retirement nest egg. That's basically the equivalent of paying the advisor another 3% of your portfolio a year. So what about the advisor's account? Well, let's assume the advisor is smart enough to invest his earnings from you, since he doesn't have to pay an advisor or use the crappy funds he's recommending for you. He can make 5% a year, just like the do-it-yourselfer. How does he make out? Well, now you can see what's going on. Money is being gradually transferred from your retirement portfolio to his. Although he has helped you grow the portfolio to 2.28 million, he's also grown his to 724,000. How many clients like you does he really need? Not very many. Remember, this assumes that after the initial purchase, all funds are held until retirement, so no ongoing loads other than the new money invested. So let's just say that you're paying the advisor throughout your retirement, because a lot of people still choose to invest in their retirement, especially if they have a job and they're working a part-time job during retirement. They're still investing. Now, let's say you need $100,000 a year from your portfolio to live on during retirement. The doctor using the advisor got to spend $3 million in retirement and left his heirs $645,000. Not too bad. Of course, in the end, it looks like the advisor ended up with more in the portfolio than he did, 4.35 million, meaning the do-it-yourselfer was able to spend the exact same $3 million and leave his heirs a whopping $8.1 million. Alternatively, he could have spent twice as much in retirement each year and still left his heirs $1.1 million, almost twice the inheritance. So guys, this shows you that the cost of using an advisor, whether you choose to use an advisor or not, can dramatically affect your portfolio. Now, I know these numbers look a little very high, especially since we're talking about doctors. So let's come over here. I found this website, guys, that it shows you, so it's an investment fees calculator. And what I did was I pulled up my Vanguard Roth IRA balance, because I know that this site right here talks about doctors, and the numbers that they share are very hard for us to understand, especially if you're not going to have millions of dollars when you retire. And if you're saving and if you're late to retirement like me, guys, I know I probably won't have $1 million in my account, but I would like to know and share with you guys more realistic numbers of what it would look like if you were paying a financial advisor. So I found this calculator online, and what we're going to do is we're going to go ahead and just plug in some realistic numbers. So I'm using my Roth IRA numbers because I just started investing about 4 or 5 years ago, and my numbers look about realistic, more realistic for somebody who's getting started late for catching up for retirement. So we're just going to plug in $43,516, and then it says annual investment amount. So right now in 2024, the amount that you can contribute to a Roth IRA with catch-up contributions is $8,000. The IRS does raise the limit every so often, and I'm not sure if they raise the limit every year, but for the sake of this video, we're just going to plug in $8,000 because that is what you can invest in 2024. We don't know what it's going to look like in 2025 and beyond, but it will go up. So it will only go up from $8,000. So we're just going to go ahead and plug in $8,000. Years of growth. So I'm 51, guys, and I'm just going to plug in 15 because I do have another good 15 years that I can continue working if I decide to or whatever. But for the sake of this purpose, I'm going to plug in 15 years because most of us on this channel are older. So we're just going to leave it at 15. Rate of return, guys, I'm just going to put in 7%. I know that's a little lower than what we could anticipate, but I want to just leave it low in case the market doesn't do really well, because we don't know what it's going to look like, but I'm hoping that it's more than a 7% rate of return. But we're going to just try to keep it just at 7% for the sake of this video. And then we're going to put a lower investment fee. So this is the amount of fees that you would pay for a financial advisor. So in the website above, he was talking about 1% fee. So we're just going to leave it at 1%, just so you can kind of get an idea. And you can see right here, it says lower investment fee. And then they have a slot right here where it says higher investment fee. And remember, financial advisors can charge anywhere from 1% to 2% investment fees or more, guys. And understand, guys, that the more that you have inside of your portfolio, the more they're going to make. So you pay their fee based on the amount that you have in your portfolio. So right here, guys, it's going to say investment value in 15 years. So it's rate of returns with a 7% interest on the lower fee, you'll have $290,496 inside of your portfolio. And then with the higher fee, guys, after you pay your fees of 2%, this is a difference of $27,401. I don't know about you guys, but that's $27,401 that you're paying somebody that doesn't have a very good track record of beating a S&P 500 index fund or a total stock market index fund. So for me, guys, I would rather just go ahead and do it myself. So guys, I know a lot of people say they just feel a lot better when they hire a financial advisor because they don't have to learn how to invest. But guys, there are several books out there, several podcasts out there that will teach you a simple way of investing. It doesn't take a lot. And guys, I'm not any smarter than you. But guys, I just wanted to show you the difference between 1% and 2%. Either way, they're both expensive. This website talks about the 1%, and you could see the big difference on the amount of money that that person had at the end of the scenarios. And then you could see what the financial advisor had. And the more people that a financial advisor manages their money, the more they make. Understand this, guys. Understand where you're putting your money and understand that it's not rocket science to learn about money and learn how to keep more of your money when you do start investing, especially if you're trying to catch up for retirement like me. I think that it's so important to be able to just learn how to manage your own money and invest and keep more of your money, guys, because we're already late to saving for retirement. You don't want to be giving it to a financial advisor. Now, as I said, guys, if you have complicated investments, if you complicated portfolios, then you might want to go ahead and hire a financial advisor. However, if you have a simple portfolio like me, where I just have one index fund inside of my Roth IRA, it's so easy for me to manage it. And I don't even have to manage it, guys. All I had to do was sign up for it one time and just put money in there, and I can automate the investments and money goes in there every month. So anyway, guys, I hope you enjoyed this. I hope it's eye-opening and to show you that how much money you pay to a financial advisor. And as I said, there's no guarantee that they're going to get you better returns than if you just invest in an S&P 500 index fund or a total stock market index fund. So anyway, I hope you enjoyed this video. If you did, guys, make sure you give it a thumbs up. Make sure you subscribe to this channel so that you can be notified when I put out a new video. And also, guys, make sure you watch this video at the end where I link right here, guys. You'll see it on either side, either the right or left side, where I recorded a video giving you a side-by-side comparison of a Edward Jones account managed with a financial advisor versus yours truly account with my Vanguard Roth IRA. And I want to share with you how I'm beating a financial advisor account just by investing in a total stock market index fund. So make sure you watch that, guys. And until next time, I will talk to you later. Have a great day. Bye.